During the first week of May, we have seen some unprecedented moves in the markets, especially the commodity futures and currencies, energies, Dow Jones. So I just wanted to take a brief look and review some of the markets and see how the action reaction theory and reversal date trading approach did during these volatile times. Is it especially these type of markets when a person should be aware of the risk involved in trading commodity futures, especially if you don't have a trading plan and you don't have proper risk management in your trading plan. First market I'm looking at is the Canadian dollar. And of course, you're going to see the market's making a huge drop, especially on Thursday, the wide range day. But could this have been predicted beforehand, or could you have taken advantage of this price move? Well, if you look at the charts, you'll see that that answer is yes, you could have. I'm marking right here. You'll see the arrow right here and this arrow right here on the 14th and 19th. Those were days, two reversal dates that were projected weeks ahead of time. And so you knew in advance that that was the time and price of a possible market change, a trend change. So I'm just going to walk you real quick through how they were projected. First of all, I'm looking back here at the TR pattern. This was at the beginning of the move. And using this TR pattern, when you did the reverse count from this point to this point, they gave you 14 price bars. That projected up here to this price bar here. Then you have a new, this is of course known as the TC pattern, the trend continuation pattern. And if you've read the book Unlocking Wealth, A Secret to Market Timing, you know exactly what that is and how it can be used. But when we do the reverse count from this point here back to this point, the low to low, to give your future price projections, it comes out with 14 days and 19 days. You do your future forward count, that's 14 bars right here, 19 bars right here. And of course, those were the two major highs before the market collapsed. And when you did your time and your price projections, the market went right up to the projected lines. Those are the reaction lines, target objectives. You'll see that it hit those lines right on the predicted date. And what did it do? It formed a brand new TR pattern, which of course is a sell pattern. Brand new TR pattern right here. Triggered a sell signal right at this point. So using the TR pattern, action reaction, you could have ridden the market up, been out near the high, and then turn around and been short during this time period. You'll see that I have marked here a future reversal date. So it looks like about Tuesday or Wednesday of next week. We'll watch this to see if we get a new reversal pattern. Taking a quick look at the Swiss franc, we also see a new TR pattern forming right here. I'll have it marked out. Which would have triggered a sell right during this time period. When you do your reverse count, starting here, counting back to this high, that's 16 bars. Starting here, you project forward 16 bars, came in right exactly on the low before you got a big rebound. And also when you did your time and price, here's your price projections that could have been made back on this price bar. So it could have been made 2 weeks in advance. The market came right down into that cluster. The cluster where the reaction line crossed the median line. There's a median line here and a median line there. So you had two median lines intersecting with the reaction lines. So the market dropped right down into the correct time, the 16th bar, and reversed right on cue. So in other words, the action reaction caught this from the beginning to the end. Now I wanted to show the Australian dollar because it has kind of a unique pattern. We do have your TR pattern right here. I'll demonstrate it. So it did kick in a sell signal right at this time period. And when you do your reverse count from this point back to this point, that's 12 bars. Well, your 12th day is clear out here. It's way in advance. But when I draw my action reaction line to get my target objective, look how the market comes right down to it. Even though it's fallen out of the pitchfork, it dropped right down to the reaction line target objective on this big price drop before bouncing back up. So even when the market still is way early, the price hit the target objective early. And that's what we call when the price gets ahead of time. That typically happens when you have huge price moves or big surprise news in the market that moves the market real quick. Moving over to the British pound, it also had a nice move, and looks like it did exactly as expected. Because if you look at the TR pattern, I'm going to draw here. We have our TR pattern. Do the reverse count back here. It's 13 bars. You count forward 13 bars. Here's the reversal date. But when we mark the reaction line, the market dropped right down into the reaction line. It hit the low. It actually took a little bit lower and then rebounded. So the market is going to be interesting to see. It looks like we have another reversal date possibly on Monday. So if the market moves up into Monday, it could be setting up another sell. But the most important thing is the market right here. You see it's in the 60% window, the sell window, which means it triggered a sell as soon as it dropped out of this area. So it caught the beginning of the move down to the end of the move and told you to get out before the market turned around and started to correct and bounce back up. Takes us to the dollar index. This is the US dollar index. Using this price pattern right here, that's 16 bars. When you do the reverse count, you start right at this point, you go 16 bars. Look where that puts you. The market rallied right up to the upper part of the parallel line, right where it intersected with the reaction line, right on the projected date. And remember, this projected date was made clear back at this point when the market confirmed this pivot point, and we knew that we had this pattern right here. We could make those projections. So it actually caught it from right around about 80 to 120 all the way up to 85 even. It picked the beginning and the end of the major price move. Now I've shown you a lot of currencies, but let's look at some of the other markets. For example, let's go over into the grains, and you'll see a really good example here in the July soybeans. The July soybeans had been moving up, and it went right here based on the pattern right here that I have drawn out. It's a TR pattern. You do a reverse count from this high to this low. That's 12. So you start at this one, you project forward 12 days, it puts you right at this point. And of course the action reaction lines put you right here. The market moved up, but it failed. It failed to reach the projected median line reaction line, which is a sign that the market is ready to turn. But it did go right up into the predicted date, made a nice move of, reversed, and came down. And look what here, we form a new reaction swing right at this point, which triggers a sell pattern right here. So you were able to ride this market from beginning to end, and then also to catch the move down based on these signals. Be sure and check out the remainder of this video on part 2 of trading volatile markets, where I go into detail on the E-mini S&P and the Dow Jones, how the action reaction projected the end, the major high right before the large drop down. If you have any questions, you want to learn more about this information, check out the website at www.tradersnetwork.com or give us a call at the numbers listed on the screen.